Imagine for a second that you are a portfolio manager at, some major institutional fund.
Right. High stakes.
Exactly. High stakes. It's 9:30 a.m. The opening bell literally just rang. And your specific mandate for the day is to acquire $1 billion worth of Apple stock before the market closes at 4.
Which is obviously not a small order.
Not at all.
Right.
And if you just pull up your terminal, type in that order size and hit market buy, you are going to instantly chew through every single offer sitting in the order book.
Oh, totally. You'd create a massive liquidity vacuum.
Right. You'd spike the stock price by like 5 or 10% in a matter of seconds. And ultimately, you would pay this massive, completely unacceptable premium for those shares.
You'd cost your clients millions of dollars in slippage alone.
Exactly. And you would likely be fired by the end of the day. So the question is, how do you hide $1 billion in plain sight?
Well, you definitely don't execute that order manually.
No, you hand it over to a specialized execution algorithm. And today, we're going to learn how to track the exact footprint that algorithm leaves behind.
Because the modern financial market, it's not really a battle of human intuition anymore. It's a landscape completely dominated by these execution algorithms.
Yeah, and retail traders often approach the market looking for these static historical patterns, right? Hoping that some horizontal line they drew on a chart from last week will miraculously hold up today.
But the institutions moving massive capital, they're operating on a highly dynamic, volume-driven mandate. They are systematically accumulating and distributing positions based on real-time mathematical averages.
Which brings us to today's topic. Welcome to The Learner joining us today. This is a deep dive into the absolute mechanics of institutional order flow.
And we are focusing our entire analysis today on one very specific, universally utilized tool, which is VWAP.
Yes, VWAP. We've gathered an incredibly extensive stack of resources to deconstruct this subject. We are pulling from deep dive trading tutorials designed by both institutional and retail veterans.
Specifically, the work of MoneyZG, Mind Math Money, The Secret Mindset, and Trader Deal.
Right, and we're cross-referencing their practical setups with the foundational, very clinical definitions provided by Investopedia.
Which is a critical synthesis, honestly, because it bridges the theoretical mathematics of market averages with the actual, boots-on-the-ground execution strategies used in active trading.
Absolutely. Our mission today is to completely demystify VWAP. By the end of this deep dive, you will understand the specific mechanisms driving this indicator and why it serves as the undisputed benchmark for intraday algorithmic trading.
And most importantly, how to calibrate your own charts to align with these institutional flows rather than, just being unwittingly used as liquidity for them.
Okay, let's unpack this. We have to start with the structural foundation. Before we even think about analyzing charting setups or specific entry triggers, we really need to dissect the underlying math and the behavioral mandate behind VWAP.
Right. So VWAP, it stands for Volume Weighted Average Price. Fundamentally, it's an intraday benchmark.
Just intraday?
Primarily, yeah. It calculates a given security's average price throughout the trading session, but it actively weights that average based on the volume of shares or contracts traded at each specific price level.
So if we break down the formula that Investopedia provides, it immediately reveals why this is so much more effective than your traditional moving average.
Oh, for sure, because the calculation relies on something called the typical price.
Right, the typical price. So instead of just looking at where a 5-minute candle closes, it takes the high, the low, and the close of that specific period, adds them all together, and divides by 3.
Which immediately gives you a much more holistic representation of the price action within that micro period.
Because a closing price is really just a snapshot of the final millisecond. Right?
Exactly. A close is just a single moment in a 5-minute window.
Yeah.
The typical price accounts for the entire range of the battle between buyers and sellers during that whole block of time.
Okay, and then we get to the actual volume weighting part.
Right. So the formula takes that typical price we just found, and it multiplies it by the actual volume traded during that specific period to get the total price volume.
PPV.
Yeah, PPV. And finally, to plot the continuous line that you see on your chart, it divides a running cumulative sum of that total price volume by the cumulative trading volume of the entire day up to that exact moment.
That cumulative aspect seems incredibly vital.
It is. It means the VWAP is constantly absorbing and contextualizing new data against the total weight of the day's activity.
I really want to focus on the distinction between this and a standard simple moving average, or SMA. Because for a trader coming from just a basic technical analysis background, the SMA is usually their default tool.
Oh, absolutely. But an SMA completely ignores volume.
Right. So if an asset moves up $1 on a volume of like 10 shares, or it moves up $1 on a volume of 10 million shares, a simple moving average treats both of those periods as having identical significance.
Which is a profound vulnerability when you're intraday trading.
How so?
Well, think about a low volume price spike. Maybe it's driven by a single erratic market order in a really thin order book. That spike will heavily distort a simple moving average.
So it pulls the average away from where the actual liquidity is concentrated.
Exactly. But VWAP mathematically suppresses that noise. Because it's volume-weighted, a low-volume spike barely even registers on the VWAP calculation.
So the line stays anchored.
Yes, the line remains anchored to the price zones where the heaviest, most significant capital actually changed hands.
Which brings us right back to that hedge fund manager scenario we opened with. The sources make it very clear that institutions don't merely use VWAP just because it's a superior mathematical filter.
No, they are practically mandated to use it by their clients and by their internal risk departments.
That concept of best execution is paramount in institutional finance, isn't it?
It's everything. When a fund delegates a massive block order to a prime broker, that broker's performance is strictly graded against the day's VWAP.
So the VWAP basically represents the true fair average price of the asset for that entire session.
Correct. If the broker manages to accumulate the required shares at an average cost below the VWAP, they've secured a discount. They performed exceptionally well.
But if they mess up?
If their aggressive buying pushes their average cost above the VWAP, they have incurred negative slippage. They overpaid relative to the market average. And if they consistently do that, the fund will absolutely take its business somewhere else.
So the brokers program their execution algorithms to be hypersensitive to the VWAP line. I like to think of it, it's like trying to fill an Olympic-sized swimming pool with a massive fire hose, but your strict instructions are that you cannot make a single wave or ripple on the surface.
That's a great analogy.
You can't just blast the water in. You have to meticulously trickle it in, drop by drop, dynamically adjusting the flow rate over the course of the entire day so the water level rises imperceptibly.
And the VWAP line is the exact gauge they use to monitor those ripples. The algorithms are designed to passively accumulate when the current price drops below the VWAP, taking advantage of the discount, and to immediately shut off or slow down their buying when the price stretches above the VWAP.
Wait, so if every major player in the market is running algorithms with that exact same logic, aren't they collectively creating a massive, localized gravitational field around that price point?
It is the literal definition of a self-fulfilling prophecy.
That's wild.
The algorithmic mandate to execute new VWAP turns the indicator into an actual physical barrier of support and resistance.
Because when price strays too far, the aggressive institutional buying or selling just ceases, drying up the momentum.
Exactly. And when price returns to the VWAP, the algorithms re-engage, creating a sudden influx of volume that defends the level. This creates a very predictable rhythm to the market.
A rhythm of expansion and mean reversal.
Yes, a rhythm that can be systematically mapped.
Okay, that transition from understanding the institutional motive to actively mapping the chart is where the practical application really begins. Let's detail how a trader actually sets up their environment to visualize this rhythm. We're primarily looking at intraday timeframes here, right?
Yes, the standard session VWAP is exclusively an intraday tool. By its mathematical nature, it requires a definitive starting point.
And for equities, that is the opening bell at 9:30 a.m. Eastern.
Right. The calculation starts fresh at zero volume every single morning. The previous day's data does not roll over.
The sources specifically recommend applying this to a 5-minute or a 15-minute chart. And when you apply the standard indicator, you just get that single, smooth central line.
But the research from The Secret Mindset introduces a layer of complexity that completely transforms the indicator. It takes it from a simple moving line into a topographical map of probability.
You're talking about the standard deviation bands.
I am. If the central VWAP line represents the absolute fair value of the asset, the standard deviation bands map the extreme edges of statistical probability around that fair value.
So when you enable these bands in a platform like, say, TradingView, you are plotting the real-time variance of price action based on normal distribution mathematics.
applying normal distribution, the bell curve, to financial markets is just fascinating because it allows us to quantify the exact likelihood of a price sustaining a specific move.
Let's break down the geometry of these bands for a second.
Okay, so the first set of boundaries are the +1 and -1 standard deviation bands.
Got it.
In a perfectly normally distributed data set, approximately 68% of all data points will fall within one standard deviation of the mean.
So in trading terms, 68% of the day's price action should naturally oscillate between these two interbands.
Exactly. So if the price is simply vibrating back and forth between the +1 and -1 bands, the market is in equilibrium.
There is no panic, no euphoria.
Just the standard algorithmic exchange of liquidity.
Okay, but then we expand to the +2 and -2 standard deviation bands. The sources say these outer boundaries statistically contain roughly 95% of the data.
Right. When the price action pushes out to touch the second deviation band, it is mathematically stretched. The underlying asset has become statistically overextended relative to its volume-weighted average for the day.
Here's where it gets really interesting to me. This is the mean reversion zone. The gravity of the central VWAP is pulling at its absolute hardest because there is only a 5% mathematical probability that the price can sustain itself outside of that area without a massive fundamental catalyst.
Exactly. And that naturally leads us to the extreme periphery, which are the +3 and -3 standard deviation bands.
The 3 sigma event.
Yes. These bands contain 99.7% of all expected price action.
So only 0.3% of trades should theoretically happen out there. I mean, if I'm watching a 5-minute chart and I see a massive green candle physically pierce the +3 standard deviation band, I'm basically looking at a literal statistical anomaly.
You are looking at a market in severe distress or total euphoria. When price hits a 3 sigma band, it signals one of two distinct realities.
What's the first one?
Either it's an exhaustion move, a final emotional blow-off top driven by late retail buyers scrambling into the market, which will almost always result in a violent, immediate snap back to the mean.
Right, the rubber band just snaps back. And the second reality.
The fundamental narrative of the asset has completely changed.
A paradigm shift.
Precisely. If a pharmaceutical company suddenly announces FDA approval for a blockbuster drug right in the middle of the trading day, the price will blast through the third deviation band and just stay there.
Because the previous volume-weighted average is instantly irrelevant.
Right, the underlying value of the company has fundamentally increased. But barring major news like that, the third deviation is the ultimate structural wall.
Okay, so this topographical map gives us the boundaries, but we still need a compass. A map is useless if you don't understand the broader terrain you are walking through.
That's a good way to put it.
The sources make a very clear distinction between how VWAP behaves in a sideways market versus a trending market. And the primary metric for identifying that context is the slope of the line.
Yes, the slope of the VWAP is a direct derivative of institutional aggression.
So if the line is flat, just tracking horizontally across your screen, what does that mean?
It indicates a balanced order book. Institutional buyers and institutional sellers are absorbing each other's flow equally. Neither side is willing to pay a premium to aggressively move the price.
But if that central line begins to angle sharply upward, it means that equilibrium has broken.
An ascending slope tells you that aggressive buyers are lifting the offers in the order book. They're paying the spread, they're buying at the ask price, and they're doing it with enough sustained volume to physically drag the weighted average higher.
And I imagine the steeper the angle of the slope, the more aggressive and urgent the institutional capital deployment is.
Absolutely. That gives us the intraday context. But there is a macro context that retail traders often overlook, which is the multi-timeframe stack.
We focus so heavily on the daily reset, but a major sovereign wealth fund managing hundreds of billions of dollars is not concerned with a 5-minute VWAP fluctuation.
They literally cannot be. Their capital size prohibits them from operating on microscopic timeframes. The multi-timeframe stack introduces the weekly, monthly, and even yearly anchored VWAPs.
And the structural hierarchy here is defined by capital weight, right?
Yeah.
The monthly VWAP holds exponentially more authority than the weekly VWAP, which obviously holds more authority than the daily.
It is a measurement of accumulated volume over time. I mean, think about the sheer number of shares traded over a 30-day period versus a single 6.5-hour trading session.
It's massive.
The monthly VWAP represents a massive, entrenched average cost basis for swing traders, macro funds, and long-term accumulators. Moving a daily VWAP takes millions of dollars. Moving a monthly VWAP takes billions.
So the practical application for a retail trader here is strict trend filtration. If you were looking at a bullish setup on a 5-minute chart and the daily VWAP looks supportive, but then you zoom out and realize the current price is completely suppressed underneath a declining monthly VWAP.
You're walking into a trap.
Right. You are attempting to buy directly into a multi-billion-dollar wall of overhead supply. So if the daily chart says buy, but the monthly chart says sell, you listen to the monthly chart. You never want to fight billion-dollar flows.
Fighting the higher time frame VWAP is equivalent to swimming against a tidal wave. But the inverse of that scenario is where the most asymmetrical trading opportunities exist. It's a concept known as institutional consensus.
When all the time frames perfectly align.
Exactly. Imagine charting the daily, weekly, and monthly VWAPs simultaneously. You want to see the daily VWAP positioned physically above the weekly position above a monthly, and the price action actively trading above all three.
And furthermore, all three lines should be sloping upward.
Yes. In that configuration, every single tier of institutional participant, from the algorithmic day trader to the multi-day swing fund to the macro accumulator, they're all profitable and they're all positioned on the same exact side of the market.
There is zero structural overhead resistance. No institutional cohort is trapped underwater looking to sell at break-even.
And when you identify institutional consensus, you routinely witness these explosive, sustained trends because the entire market architecture is facilitating the move. They can run 3 times further than normal.
Wow. Okay, so we've established the theoretical physics of the indicator. We've got the math, the probability bands, the slope, and the macro hierarchy. Now we really must translate that theory into execution.
It's time for the playbook.
Exactly. We are moving into the practical playbook, detailing the specific tactical setups outlined by the experts we researched. And the first strategy is engineered for the flat slope environment, the rotation setup.
The rotation setup capitalizes on the mechanics of a balanced order book. You identify this regime by observing a flat central VWAP line accompanied by first standard deviation bands that are basically moving in parallel horizontal lines.
So the market is trapped in a sideways channel.
It's consolidating. In this environment, the algorithmic mandate we discussed earlier is running flawlessly. The algorithms are programmed to passively buy when the price drops below fair value and sell when it rises above.
So the trader's strategy is to simply front-run this algorithmic mean reversion. You wait for the price to drop and make physical contact with the lower support deviation, which is typically the -1 or -2 band.
Yeah,
right?
depending on the day's specific volatility.
And because we know the statistical probability heavily favors a rejection of that extreme, we look to execute a long position right at that lower boundary.
Yes. The execution is highly mechanical. You buy the lower deviation band, you look for the price to snap back to the mean.
And where do you take profit?
Your primary take-profit target is the central VWAP line itself, because that is the literal center of gravity. And then you just execute the exact inverse at the top of the range. If price pushes up to the +1 or +2 resistance band, you initiate a short position, targeting a return to the central line.
It is an incredibly systematic way to extract capital from a low-momentum market. But eventually, a catalyst occurs, right? Volume enters, the slope aggressively angles up, and the regime changes from rotation to trend.
And if a trader attempts to use the rotation strategy in a trending market, they will be absolutely decimated.
Which brings us to the trend setup and the phenomenon known as the band walk.
In a high-momentum directional trend, the psychology of the market completely shifts. The aggressive institutional buyers are no longer willing to wait for the price to return to the central VWAP.
Because if they wait for fair value, the market will just run away from them. They are forced to pay a premium to secure their massive allocations.
The urgency overrides the desire for a discount. And this urgency physically alters the interaction between price and the standard deviation bands. In a powerful uptrend, the price will push right through the +1 standard deviation band.
And when a minor pullback finally occurs,
the price will not retrace all the way to the central VWAP. It will retrace only to the +1 band and then immediately bounce higher.
Oh, I see. The previous ceiling, the upper probability boundary, has structurally flipped into the new moving floor.
This is the band walk. The price essentially surfs the upper periphery of the probability curve. For a retail trader, the entry trigger completely changes here. You are no longer buying at the central line. You are placing your limit orders directly on the +1 deviation band.
You're buying the shallow pullbacks as the momentum carries the entire statistical model higher. That perfectly illustrates how dynamic the indicator is. Now, the playbook shifts depending on the asset class and time frame as well. I want to transition to a specific macro strategy detailed in the MoneyZG research, which applies VWAP to the cryptocurrency market, specifically mapping Bitcoin drawdowns.
This is a major departure from intraday scalping. It is a macro swing trading framework designed to navigate the extreme inherent volatility of digital assets. We shift our time frame from a 5-minute chart to a daily chart.
The setup requires two specific indicators: a VWAP that is anchored to reset weekly, overlaid with a standard 50-period simple moving average.
Yes.
And there's a behavioral component to this strategy that I found brilliant. The source suggests hiding the actual price candles from the chart entirely.
Hiding the price action removes the psychological trauma of watching a massive red candle during a crypto correction. You are isolating the pure mathematical relationship between the volume-weighted average and the unweighted time average.
So we are scanning the chart for a very specific intersection. We're looking for the exact moment when the line of the weekly VWAP crosses underneath the line of the 50-period SMA. Why is that specific crossover geometrically significant?
The 50-period SMA on a daily chart represents a widely recognized medium-term baseline. When the weekly VWAP, which is highly sensitive to recent volume-heavy selling pressure, drops violently enough to cross beneath that 50 SMA, it mathematically confirms that the asset has experienced a severe, localized structural break.
In the context of a macro Bitcoin bull market, this specific crossover historically aligns with the classic 10%, 15%, or 20% drawdowns.
It is an algorithmic alarm bell signaling that the dip has officially arrived.
It identifies a zone of capitulation. Weak hands have been flushed out, volume has spiked on the sell-off, and the asset has reached a point of maximum structural tension.
It's the optimal accumulation zone before the broader macro trend resumes.
The tactical execution of this requires strict discipline, though. You do not deploy your entire capital base on the first signal.
No, you utilize a scale and methodology. You allocate a percentage of your position at the initial 10% drawdown confirmation, another allocation if the market degrades to a 15% drawdown, and the final tranche at the 20% extreme.
And we really must address the critical element of leverage in this environment. The strategy explicitly mandates a maximum leverage limit of 2x for these swing trades.
The mathematical rationale behind capping leverage at 2x is purely defensive. A 2x leverage ratio provides the trader with a 50% drawdown buffer before facing forced liquidation.
Which is crucial in crypto.
Exactly. If you deploy capital at a point where Bitcoin has already corrected 20% from its local high, the statistical probability of the asset experiencing an additional immediate 50% collapse without any intervening relief rally, while still inside a macro bull market structure, is exceedingly low.
The 2x cap ensures that you have the structural oxygen to survive further localized volatility without being wiped out.
That's the perfect way to phrase it.
We have covered equity rotation, momentum band walks, and macro crypto accumulation. Let's look at one final strategic pillar here: confluence. The Trader Dale material specifically analyzed gold and forex markets to demonstrate that VWAP should never be utilized in a vacuum.
Utilizing any single technical indicator as a standalone thesis is a critical vulnerability. You are relying on just one dimension of data. The highest probability setups require confluence.
The simultaneous alignment of multiple independent technical methodologies pointing to the exact same price level.
Exactly. The research paired VWAP with a tool called volume profile. If VWAP is a running average mapped over time on the x-axis, volume profile maps historical accumulation on the y-axis.
Volume profile generates a histogram on the right side of the chart, detailing exactly how much volume was transacted at every specific price increment over a given period.
And it visually identifies volume nodes, these thick clusters of historical trading activity.
These nodes represent dense forests of liquidity. If price moves into a high-volume node, it bogs down because it has to chew through thousands of resting limit orders.
Right, so imagine analyzing a gold chart during a volatile London session. The price is retracing downward. You calculate that your -1 standard deviation VWAP band is actively resting at, say, $2,350 per ounce.
Okay.
Simultaneously, you analyze your volume profile and discover that the most massive, dense volume node of the entire week is also resting precisely at 2,350.
Wow. You have two completely distinct mathematical models: a dynamic standard deviation probability curve and a static historical volume histogram overlapping at the exact same coordinate.
That overlap creates an impenetrable structural wall. It is the ultimate zone of confluence. When price approaches that coordinate, the probability of a successful bounce is exponentially magnified.
Because different cohorts of institutional algorithms, the ones trading VWAP mean reversion and the ones defending historical volume nodes, they will both activate simultaneously to defend that exact price level.
That is the architecture of a high probability trade. But mapping the setup is only a fraction of the battle.
Yeah, the harshest reality of intraday trading is that a mathematically perfect setup will still liquidate an account if the trader lacks psychological resilience and a profound understanding of risk management.
We really need to dissect the psychological warfare engineered by market makers, specifically the phenomenon of the false break trap.
This trap is responsible for more retail losses than perhaps any other intraday pattern. It preys directly on the emotion of FOMO, the fear of missing out.
Let's analyze the actual mechanics of a fakeout. It is not an accident. It is an active liquidity extraction maneuver. Imagine the price of an asset is slowly grinding up toward the central VWAP line from below.
Okay, setting the scene.
The broader retail market is watching this level closely, anticipating heavy resistance. They have their short positions queued up and their stop losses placed tightly just above the VWAP line.
The institutional algorithms monitoring the order book can see this immense cluster of resting retail liquidity, right?
They absolutely can. If a major fund needs to distribute or sell a massive block of shares, they require buyers. But if everyone is currently bearish and expecting resistance, there are no buyers to absorb the fund's massive sell order.
So the algorithm manufactures the buyers.
It engages in momentum ignition. The algorithm rapidly fires aggressive buy orders, intentionally paying the spread and spiking the price straight up through the VWAP line in a single massive green candle.
To the retail trader watching that 5-minute chart, this looks like an explosive confirmed breakout. The resistance has shattered. The retail shorts panic as their stop losses are triggered, which forces them to buy to cover.
And the retail breakout traders experience massive FOMO and just smash the buy button to catch the new uptrend.
The institution has successfully generated a massive pool of frantic retail buying pressure.
And the very millisecond that retail liquidity floods the market above the VWAP line, the institutional algorithm immediately dumps its massive block of sell orders directly into it.
The retail demand is instantly absorbed and overwhelmed. The price violently rejects, collapses back down below the VWAP, and leaves a graveyard of trapped retail buyers holding losses at the absolute high of the move.
That is an incredibly predatory mechanism.
So how does an independent trader systematically defend against a supercomputer executing a liquidity grab in milliseconds?
You defend against speed with patience. You implement the 3-candle rule.
The 3-candle rule.
When a massive candle breaks through a critical VWAP level, your immediate instinct will be to execute a trade. You must override that instinct and force yourself to observe. You wait for the close of the breakout candle. Then, you wait for the close of the second candle.
And finally, you require the 3rd consecutive candle to maintain the price level on the new side of the VWAP.
The logic being that an institutional liquidity grab is designed to be instantaneous. A fakeout cannot sustain itself for 3 consecutive 5-minute periods because the true institutional weight is actually pushing in the opposite direction.
So if the price breaks, but fails to hold and immediately wicks back down on the second candle, the trap is exposed.
But if the price breaks, consolidates on the second candle, and maintains structure on the third, it mathematically demonstrates that the broader institutional market has actually accepted the new valuation. The breakout is structurally legitimate.
The anatomy of the individual candlestick provides massive context during these interactions, doesn't it? The sources focus heavily on analyzing the wicks of the candles as they touch the VWAP boundaries.
Oh, a candlestick wick is the visual footprint of an absorbed attack. Suppose the price drops sharply, piercing the -1 deviation band. But by the time the 5-minute period closes, the body of the candle has closed all the way back up above the band, leaving a massive long wick pointing downward.
That wick indicates that sellers aggressively push the price down into that zone, but an even larger wall of resting institutional buy limit orders was waiting there. The buyers absorbed the entirety of the selling pressure and violently reversed the momentum before the clock ran out.
It is a visual confirmation of institutional defense. When you see a long wick rejecting a standard deviation band, it is a high probability signal that the mean reversion algorithm is active.
Conversely, if a large, solid-bodied candle with 0 wick closes decisively straight through a standard deviation band on massive volume,
the defense has capitulated, the level is lost, and the trend is accelerating.
because the volume confirms that the institutions are driving the brake, not attempting to defend against it.
Exactly.
This brings us to the mathematical geometry of risk management. The Secret Mindset material detailed a brilliant dynamic methodology for position sizing that integrates directly with the multi-timeframe hierarchy we discussed earlier.
Standard risk management often relies on static percentages, risking 1% of the account per trade, regardless of the structural context. The dynamic approach calculates position size inversely proportional to the asset's distance from the monthly VWAP.
The monthly VWAP serves as the absolute baseline of fair value.
Consider a scenario where a stock is caught in a massive momentum squeeze. The current price on the 5-minute chart is trading 6% above its monthly VWAP. It is in the stratosphere, structurally divorced from its long-term average cost basis.
Their rubber band is stretched to its absolute limit.
The risk of a violent gap-down mean reversion event is exceptionally high in that zone. Therefore, if you are attempting to execute an intraday long position at that extreme elevation, the dynamic rule dictates you must drastically reduce your exposure.
You cut your standard position size in half or even to a quarter. You are trading in thin air, you must carry a lighter pack.
But if the daily setup triggers while the current price is consolidating just 1% away from the monthly VWAP, sitting directly on top of the macro fair value baseline,
the structural risk of a massive, unforeseen snapback is mitigated. The rubber band is relaxed. In that environment, you have the mathematical justification to deploy your full maximum position size.
And regarding the placement of the stop loss itself, the rule is to never rely on an arbitrary dollar amount or a fixed percentage trailing stop. The stop loss must be placed structurally.
So if you execute a long position at the central VWAP line, expecting a bounce, placing a tight 10-cent stop loss directly underneath your entry is a guarantee that you will be stopped out by normal market noise.
The stop loss must be positioned just outside the next logical structural barrier.
You nestle the stop loss safely behind the armor. You place it just outside the -1 standard deviation band, or just below the massive volume node on the profile histogram.
You place the stop at the exact coordinate where your trade thesis is mathematically proven wrong. If the price has enough momentum to break through the VWAP, break through the deviation band, and slice through the volume node, the entire structural environment has changed. You want stop loss to trigger immediately because the trade is dead?
We have outlined a robust, mathematically sound system. But as an objective analyst, I really must highlight the vulnerabilities of the model. There are specific environments where the VWAP indicator completely deteriorates and becomes a liability. The primary failure point is a lack of volume.
Because VWAP is entirely derivative of traded volume, an absence of liquidity destroys its efficacy. If you attempt to trade VWAP during the dead zone of the midday lunch hour or during a low-volume holiday week, the mathematical weighting mechanism breaks down.
If the volume drops below 30% of its normal average, a small handful of retail orders can inadvertently drag the VWAP line around.
It ceases to represent a massive institutional consensus and instead reflects random low-conviction noise. The standard deviation bands will contract. Price will lazily drift back and forth across the central line without any structural rejection, and the mean reverting properties will vanish.
So you really must monitor a volume oscillator alongside the VWAP. If the volume is dead, the VWAP is dead.
The second major failure point involves structural continuity, specifically massive overnight gaps in the equities market.
Imagine a stock closes the regular session at $100. Overnight, a major geopolitical event occurs, and the stock opens the next morning at $115. A massive 15% gap up.
Because the standard session VWAP resets at the opening bell, it will begin calculating its new average right there at 115, completely isolated from yesterday's data.
And that isolation is the problem. The new daily VWAP is anchored to a price point floating in a vacuum, utterly disconnected from the massive structural battleground of volume that was established the day before at $100.
The continuity of the market's memory is severed. In these extreme gap scenarios, the standard daily VWAP will be highly erratic and unreliable for the first several hours of the session until enough new volume is transacted to anchor the average legitimately.
And finally, the most psychologically damaging environment, the high volatility, non-directional whipsaw market.
This is the environment that destroys undisciplined traders. The market is churning violently, reacting to conflicting news algorithms. You observe the price aggressively crossing above the VWAP line, triggering a long signal, only to immediately reverse, slice back down through the VWAP, and trigger a short signal, which also immediately fails.
It is the death by 1,000 paper cuts. The standard deviation bands physically begin to look like an accordion, expanding and contracting wildly as the algorithm struggles to calculate the variance.
When you recognize this erratic, high-velocity chop, the only mathematically sound strategic decision is to disengage. Close the terminal. Cash is a perfectly valid position. The market is not offering a clear probability edge, and capital preservation becomes the sole objective.
We are entering the final phase of our analysis, and I want to pivot to an advanced application that essentially bridges the gap between the intraday tactical setups and the macro structural environment. We've discussed how the standard VWAP is tethered to the 9:30 a.m. opening bell. But what if a massive paradigm-shifting event occurs at 2 p.m. on a Wednesday?
This is where we transcend the limitations of traditional charting software. If the Federal Reserve unexpectedly announces an emergency interest rate cut at 2 p.m., or if a company releases a shocking earnings report in the middle of the session, the morning VWAP calculation is instantaneously rendered obsolete.
The fundamental data driving the algorithmic models has changed.
Retail charting platforms force traders to think in arbitrary daily sessions. Institutional capital does not think in daily sessions. It thinks in events. To align with this institutional perspective, we utilize an advanced tool called the event-anchored VWAP.
Instead of allowing the indicator to automatically reset at the daily open, the trader takes manual control. You select a specific, highly consequential coordinate in time on the chart, and you anchor the beginning of the VWAP calculation to that exact millisecond.
Consider the release of a highly anticipated Tesla earnings report. The numbers are released, the volatility is explosive, and millions of shares change hands in minutes. Most retail traders will struggle the next day, attempting to map their 5-minute setups to the new daily VWAP reset, getting chopped up by the residual noise.
But the institutional analyst ignores the daily reset.
The institutional analyst takes their anchored VWAP tool, locates the exact 1-minute candle where the earnings data hit the wire, and anchors the calculation there. The indicator now generates a continuous, running volume-weighted average from the precise moment the new fundamental reality was injected into the market.
It strips away all the irrelevant historical data and tracks the exact cost basis of the capital that is reacting to the new narrative.
That specific anchored line will not merely act as resistance for an afternoon. It will establish itself as a massive, undeniable structural magnet for weeks or even months. Whenever the price eventually retraces back to that earnings-anchored VWAP, it is physically encountering the exact average price where billions of dollars were accumulated based on the new fundamental thesis.
And the institutions will violently defend that level to protect their massive positions.
Exactly.
You can theoretically anchor a VWAP to any major catalyst. You can anchor it to the exact minute of a pivotal Fed chairman's speech. You can anchor it to the absolute nadir of a flash crash to map the exact average entry of the aggressive dip buyers.
You are no longer just looking at a mathematical average. You are forensically charting the historical footprint of monumental capital allocation.
This has been an exhaustive deconstruction. We have traversed from the foundational mechanics to the highest levels of algorithmic theory. Let's synthesize the core architectural pillars we have built today. We began by discarding the two-dimensional illusion of static support and resistance, recognizing that true market structure is a dynamic, volume-driven fluid. We dissected the typical price formula and the institutional mandate of best execution that fundamentally weaponizes the VWAP indicator. We overlaid the mathematics of normal distribution, utilizing standard deviation bands to transform a single line into a topographical map of extreme statistical probability. We established contextual frameworks, learning to read the derivative slope of institutional aggression and respect the capital weight of the multi-time frame monthly and weekly hierarchy. We analyzed tactical execution, extracting capital in rotation regimes via mean reversion, surfing the momentum via the band walk and trending environments, and identifying localized macro capitulation in Bitcoin using the weekly VWAP and 50 SMA crossover.
We emphasize the absolute necessity of confluence, fusing standard deviation math with historical volume profile nodes to build impenetrable structural walls.
And crucially, we addressed the psychological warfare, dissecting the mechanics of the algorithmic fakeout, enforcing the three-candle rule for structural acceptance, dynamically scaling risk based on deviation extremes, and deploying the event-anchored VWAP to track the true memory of the market.
It is a profound analytical framework, but it demands relentless discipline to execute without emotion.
It requires a paradigm shift in how you process market data. And as we conclude this deep dive, I want to leave you with a theoretical projection that builds on everything we have mapped today. We have thoroughly established that traditional institutional execution algorithms are rigidly programmed to orbit the VWAP for efficiency. And simultaneously, thanks to the proliferation of advanced charting software, millions of retail traders are now mathematically sophisticated enough to map those orbits using standard deviation bands and volume profiles.
The informational asymmetry is slowly compressing.
But the market is an eternal arms race of liquidity extraction. If the most advanced quantitative funds are fully aware that a massive cohort of educated retail traders is now patiently waiting to execute mean reversion buys exactly at the -2 standard deviation band, and placing their stop losses precisely tucked behind the -3 standard deviation band. How long until an entirely new generation of purely AI-driven predatory algorithms is deployed?
Algorithms that are not designed to efficiently accumulate shares, but explicitly engineered to hunt.
Exactly. Supercomputers programmed to intentionally push the price matrix out to those extreme 3 sigma statistical boundaries, purposefully trigger the massive clusters of retail stop losses resting there, harvest that absolute ocean of forced liquidity, and violently snap the price back to the mean before a human could even react.
It is a chilling evolution of market microstructure. Are we transitioning from an era of analyzing institutional accumulation into an era of pure statistical algorithm versus algorithm warfare, where the mathematical boundaries themselves become the bait?
It forces you to question the nature of the liquidity you are interacting with on the screen. We want to bring this analysis directly to you. Do you actively utilize VWAP and standard deviation bands in your intraday charting framework? How specifically has this volume-weighted perspective altered your ability to navigate high-volatility environments like gold or Bitcoin? Have the mathematical bands saved you from a brutal algorithmic liquidity grab, or are you still calibrating your setups to survive the whipsaw?
Mastering the geometry of order flow is a continuous evolutionary process.
It absolutely is. Thank you for dedicating your time to explore the mechanics of the market with us on this deep dive. Keep questioning the structural integrity of the lines on your chart, keep tracking the footprint of the volume, and as always, keep learning and stay intensely curious.